Welcome back to The Explainer. Today, I'm putting on my skeptical equity research analyst hat to totally rip apart iHeartMedia's first half 2026 financials. We're strictly looking at the numbers, digging into those filings, and hunting through the footnotes. We've got to figure out, is this company a brilliant digital turnaround play or just a massive sinking debt trap? Let's get into it.
But first, we got to do the mandatory legal housekeeping. Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Okay, here is our agenda for today. 1. The investment case. 2. The digital audio lifeline. 3. The massive debt anchor. 4. Media blackout flags. 5. SiriusXM savior. And 6. Our final verdict.
Section 1. The investment case. Buy, sell, or hold. Right out of the gate, looking at the mainstream financial data, things get seriously confusing. There is a massive disconnect in the analyst community right now. Just look at this data from investing.com. We've got a consensus sell rating. Literally 0 buys, 2 holds, and 2 sells. But wait, here's the crazy part. The average 12-month price target is $3.62.5. Compared to the current price of around $2.68, that target actually implies a massive 35% upside. So, what's up with the math here? Why are analysts telling you to sell a stock they technically think is going up? Well, to answer that, we basically have to split this company right down the middle.
Section 2. The digital audio lifeline. A tale of two companies.
To really understand iHeartMedia today, you've got to realize it's essentially a rapidly growing, highly profitable digital startup that's completely trapped inside the ribcage of a legacy radio broadcast dinosaur. The Q2 2026 filings brilliantly illustrate this huge divide. Check out the Digital Audio Group. They brought in $364.1 million in revenue, up 12.4% year over year, and they're operating with an incredibly healthy 33.8% EBITDA margin. But then, look right below that at the multiplatform group, which is the legacy terrestrial broadcast segment. Revenue actually shrank by 1.6% in Q2, and the segment's EBITDA dropped by a staggering 39.2%. In fact, management pointed out this is the 6th consecutive quarter where digital audio EBITDA was actually larger than the legacy multiplatform EBITDA. So the absolutely crucial takeaway here is that podcasts and digital audio are the sole lifeline for this entire corporation. I mean, they are the #1 podcast publisher by reach. Podcast revenue specifically surged 26.9% in Q1 and then another 20.7% in Q2. And they are aggressively monetizing this through cross-platform expansion. They're launching the advertising industry's first video podcast deals with heavy hitters like Netflix and Disney's Hulu. If you just looked at this in isolation, you'd think, wow, this is an incredible growth stock. But, we can't ignore that legacy side. And more importantly, we really can't ignore the massive debt that came along with it. Section 3. The massive debt anchor. Let's see how this builds into the primary bear case, because as an equity research analyst, you just can't talk about iHeart without addressing the massive elephant that's completely crushing their balance sheet. Keep this number locked in your head. The entire equity value, the total market capitalization of iHeartMedia right now is just over $414 million. That's it. That is what the public market says the company's equity is actually worth. Now compare that to this, $5.04 billion in total debt as of Q2 2026. This isn't just some abstract number on a spreadsheet. It is a brutal financial anchor costing them an estimated $440 million in interest expense alone for 2026. Let that sink in for a second. Their annual interest payment to creditors is literally larger than the entire market capitalization of the company. And as you'd expect, servicing that monster debt drives extreme volatility in their cash flows. In Q1, they burned through $114 million in negative free cash flow. Why? Well, management noted it was driven by an increase in interest expenses tied to debt refinancing timing. Now, while Q2 did swing back to a positive free cash flow of $46 million, that violent Q1 cash burn really highlights the brutal reality of their obligations. Sure, the digital side is generating cash, but the debt is just eating it alive. Section 4. The 7+7 Media Blackout Flags. As investigative analysts of financial statements, we don't just blindly read management's rosy press releases, right? Bypassing the headline hype, here are 7 deep red flags you need to know. Number 1. that Q1 free cash flow of negative $114 million. Media ignores it because it disrupts the whole turnaround narrative. Number 2, 2026 interest exceeding the market cap. Way too depressing for a quick soundbite. Number 3, Q2 legacy EBITDA dropping 39.2%, conveniently buried beneath consolidated adjusted EBITDA numbers. Number 4, missing Q1 EBITDA guidance, masked by management blaming, quote, non-cash marketing. Number 5, a net loss of $82.5 million, totally ignored in favor of adjusted metrics. Number 6, a 6.9x net leverage ratio. Honestly, just too complex for fast headlines. And number 7, explicitly noting March ad softness, which gets ignored even though it signals terrifying macroeconomic cracking. But hey, to be completely objective, here are 7 overlooked green flags. Number 1, digital margins hitting 33.8%, totally overshadowed by the legacy radio debt. Number 2, $46 million in positive Q2 cash flow, ignored because bears only ever focus on the Q1 burn. Number 3, $150 to $200 million in hidden tax shields. This requires reading the tax footnotes, which, let's be real, journalists rarely do. Number 4, $50 million in new annualized cost cuts, just not as flashy as revenue growth. Number 5, extending the credit facility to 2029. A bit too technical, but it effectively removes near-term bankruptcy risk. Number 6, 6 straight quarters of digital beating legacy EBITDA. Doesn't fit the radio is dead narrative. And number 7, a massive wave of political ad spending, treated as temporary, even though it's a major near-term catalyst. Section 5, SiriusXM, a potential savior. With the stock beaten down to under $3 and all that debt suffocating the company, are there any immediate external market catalysts? Well, earlier this year, Bloomberg leaked reports of early-stage merger talks between iHeartMedia and SiriusXM. Look at the strategic logic here. It's fascinating. iHeart reaches 9 out of 10 Americans monthly, but has a tiny $414 million equity cap. SiriusXM, on the other hand, has a massive $8.8 billion market cap, but they rely entirely on a walled-off subscriber base. Merging these two would create a $12 billion audio behemoth with unparalleled scale across broadcast, satellite, and podcasting. Now sure, it's just a rumor for now, but a buyout or merger is the exact type of lifeline that would instantly rescue iHeart's beaten-down equity holders. Section 6. Moat and Synthesis. The Final Verdict. First up, valuation. We ran this through the ultimate valuation gauntlet of 21 models. Group A, discounted cash flow and unlevered free cash flow models. They yield negative equity values thanks to that massive debt burden. Group B, dividend and income models, like the dividend discount model and economic value added, return zeros. There is simply no yield here. Group C, comparables show they traded at severely depressed enterprise value to EBITDA multiples compared to their peers. Group D, asset-based liquidation value points to a severe deficit. And Group E, real options valuation on their podcast pipeline, actually offers a glimmer of hope, but honestly, it's not enough to offset those obligations. Averaging all 21 models, the stock is deeply overvalued on an enterprise basis. Let's do a quick reality check with the investing legends. Ben Graham, he would run away. His Graham number is literally incalculable with negative earnings, and the price heavily exceeds net current asset value. Peter Lynch's PEG ratio, which divides PE by growth, completely fails because legacy growth is stagnant. And Warren Buffett, he'd cite that massive net debt to EBITDA ratio and sprint for the exit. Technically, it's only as a sum of the parts digital turnaround that they look undervalued, and that's assuming they don't default first. Next, let's define their economic moat. According to Morningstar's criteria, they possess immense intangible assets and efficient scale. I mean, reaching 250 million listeners a month is a massive structural advantage that takes decades to build. However, their moat is split in two. The legacy broadcast radio moat is undoubtedly shrinking. Revenues and EBITDA there are just declining. But their digital and podcasting moat, that is rapidly expanding, stealing market share and signing massive top-tier distribution deals. Over the next 3 years, you can expect the legacy broadcast moat to erode while the digital moat widens significantly. So what's the nuanced takeaway here? Basically, iHeartMedia is caught in a desperate race against the clock. The high-margin digital audio segment is currently subsidizing the decay of terrestrial radio, but that $5 billion debt anchor is so heavy. It all comes down to timing. Can the digital rocket ship achieve escape velocity before the legacy debt pulls the entire operation down into the ocean? The basic models and that crushing debt load are definitely pointing one way, but those hidden tax shields, the massive digital margins, and potential merger flags suggest there might be an epic turnaround brewing in the storm. So which side are you on? Are they a turnaround gem or just a massive debt trap? Do your own homework, dig into those 10 cues, and drop your thesis in the comments below. Thanks for joining me for this explainer, and keep learning.